Hi, welcome back to Channel 11. I'm Ken Shinoda, your host. Today's April 3rd. It's a day after Liberation Day, and our portfolios are getting liberated from all their gains as we enter the land of pain. S&P down, I think, almost 5%. The NASDAQ down almost 6%. Bloodbath out there today. So here we see the land of gains, and it's turned into the land of pain. The market's been selling off pretty dramatically today. But in the big scheme of things, we were at levels here last September. So we've kind of been going sideways. Maybe the market got a little bit overheated. We've been talking here for months about these trend changes, and the tariff news from yesterday has accelerated some of that. The tariff news has raised growth concerns. So here we see 2025 GDP forecasts, the U.S. in the green, coming down. And this is even before the tariffs. This is the day before the tariffs. You can see continued downgrades. And now there's new estimates that growth could fall even further. We'll get into that in a second. What else has been happening? Well, the soft data sentiment has been collapsing, both small business and consumers. A lot of concerns around all the uncertainty of the tariffs. I guess some certainty is here. We know what those numbers are, 10% on the lower end, and then roughly half of whatever we're getting from the other side in those reciprocal tariffs. And now we're all waiting to digest and see what happens. I think a lot of this is some type of negotiation tactic to try to get concessions. It's just a matter of how much concessions can we get, and what that all means. And there's so much uncertainty with that. Risk markets don't really know what to do. Now, as far as hard data, earlier this week, manufacturing PMIs came in sub 50 again. Also, services disappointed the downside. So one of the lowest services PMIs we've seen in a while. We need more info here, but these trends are pointing to slower growth, which we're already seeing as we look at things like Atlanta GDP Now estimates. Prices paid, also a little surprise to the upside there on manufacturing PMIs. Services prices paid kind of going sideways. So here we have this kind of dilemma the Fed is in with this expectations of slowing growth and expectations of rising inflation. And that, both those things, how can they cut rates when maybe inflation is going to pick up because of the tariffs? It kind of puts them into the bind. The market, at least for now, is expecting them to cut towards the end of this year because of growth. So growth will outweigh their inflation fears, because slower future growth will eventually lead to deflation potentially, or slower inflation. Employment, PMI numbers, both sub 50. They've been there for a while on the manufacturing side, but I guess this is positive for maybe less pressure on wages. So Deutsche Bank had some forecasts for what tariffs could mean for growth, unemployment, inflation, and the Fed's actions. And the tariffs came out basically at their downside expectations, which was higher tariffs than expected. I think a lot of the market thought we'd get about 10 to 15% reciprocal, and we ended up more around 25. And so I've looked at a couple different forecasts from different economists, and it's about 1% to 1.5% lower on real GDP, and about 1.5% higher on inflation is what most expect. And thus a lot of downgrading on S&P 500 targets, not surprisingly, but also more downside in Fed funds rates, more cuts by the Fed than initially expected. Some slides we've been watching. Mag 7, big drawdown. This is the current drawdown from the peak in January, down about 24%. The equal weight S&P versus the S&P index, or market value weight, we had noted that equal weight had been outperforming, but now you're starting to see even the equal weight basically play catch up. All the other stocks that weren't the Mag 7 that were playing catch up on the way up are now playing catch up on the way down. And so this ratio is moving sideways right now. And we'll just have to watch that. Now, another thing that we've been watching is the speculative fervor. We've been saying that things like Bitcoin and Dogecoin, ARK, Tesla had started leading on the way down before the rest of the market followed. And so that stuff's kind of stabilized here a little bit. I'm not sure if this slide is updated through this afternoon. I think it is. But Tesla actually oddly outperforming. Part of it has to do with that they make all their cars here, The car companies that are really suffering are the ones that have more of their production lines in other places like Canada and Mexico, for example. Semiconductors also down a lot, down 31% now from their peak here. And, this is a lot has to do with that concept. Have we seen peak AI frenzy? It all started with that DeepSeek coming out saying, hey, maybe we don't need as many processors to do the calculations that the AI models need. Maybe we don't need as many data centers. And so you've seen a big pullback in those expectations. 31%. So bear market territory for the semiconductors here. See if we get a dead cat bounce on some of these things. We saw a really deep, dark sell-off today. It was the biggest sell-off since 2020 during the COVID times. Trump trades continue to reverse. They kind of went sideways for a little bit, but the hopes of tax cuts helping small caps, the hopes of the thought of inflation pushing rates higher, which it did at first. But even with tariffs are now, as we see, it's the negative growth aspects of tariffs are overweighing the short-term inflation. So interest rates coming down, big rally, saw the 10-year dip below 4% for the first time since the fall of last year. Financials also got hit big today, and the dollar continues to get weaker, significantly off at its highs of January, got all the way up to almost 110, now sitting at 102. Equity performance, this is, I believe, not through today. This is going to be about a day stale, so you could take about 2 to 5% off everything. So now you're going to see maybe some of these European equity bourses no longer positive on the year, but still a very big divergence. Tech leading the way down, small caps, Europe outperforming, even EM outperforming, but they had lagged. So they played catch up earlier this year. We saw that, and now we're moving on the way downside. So let's watch some of these narratives. The European outperformance narrative, that was before the tariffs. Things could change now. So we've been watching these European equities. You can see the FTSE on the right had this big tear up in January, giving a lot of that back. MSCI emerging markets also had a big move up starting in January. Looks like it's giving back about a third of the run up. Stocks Europe, huge run up in January, also given looks like about half of that back. Now think about it. Europe, it's more of a manufacturing economy, and we import a lot of European goods. And if exports are going to slow because of the tariffs, then that's going to create some complexities for them. And even though they may be spending, like Germany is going to be spending to increase their manufacturing capacity, is this global growth slowdown that could be caused by tariffs and potential trade wars, is that going to outweigh the benefits that the market expected a few months ago? And so I don't know about this, but maybe it's not the case. So maybe this whole "Make Europe Great Again" trend is a little bit overplayed, and you can see we've given some back here on the "Make Europe Great Again" or mega trend. Had a big outperformance, and now it's retracing some of that outperformance. What's fascinating is this Euro USD chart that we've looked at. It's like a mirror image of what happened during the last Trump administration. For sure, these trade wars are not positive for the dollar. If we're going to be buying less from other countries, they're not going to have as much demand for putting those dollars back and investing them in dollar-denominated assets. So maybe you see continued weakness of the dollar against major currencies. Goldman yesterday or 2 nights ago, before the tariff announcements in the Rose Garden, came out saying they thought the yen was a good currency haven play, and it looks like that's been working out. We're here down at 145, where we got all the way up to 160 on the yen versus that dollar. So something to think about is the end of that bull run in the dollar, and maybe continued dollar weakness, especially against some of these other currencies. Commodities pulling back here on the weakness in equities and the fear of global growth slowdown. Oil was down, I think, 6%. So big sell-off today. Slow global growth, less demand for energy. If you look at commodities, this again is through as of April 2nd, so it's missing today. This actually takes energy into the red on the year now. But really the winner's precious metals. Gold is has, I think, its best return since like 1986 for gold. Up at one point was up 19% through the end of March. Has given it a little bit back. Silver also today correcting a little bit. So we'll see. Some technical analysis people out there were calling for a 5 waves up in gold and end of this bull run there, but they've often been wrong. Just noting that. Interesting thing to watch and think about. Okay, Treasury yields down across the board. Curve is steepening. The 10s, I said today, we saw 10-year break down below 4% for the first time since the kind of fall of last year. Credit curve continues to steepen. 230s now, 78 basis points. We saw the long bond kind of lagging, hitting some resistance. It broke through 450, but was having trouble going lower. I think it got down to like 476 or so at one point today, but really not much lower than that 450 area where you saw the rest of the curve push more materially lower down 15 plus basis points, kind of like 2 to 10 year portion of the curve. So for March, mixed bag, credit underperforming and higher quality parts of the market doing better. As we look year to date, this again is through March 31st. So a lot has happened since March 31st. Rates are lower, spreads are wider, equities are down more. But this showed you that the higher quality parts of the market and fixed rate quality parts of the market, basically the parts of the market that have been lagging, things like treasuries, agency mortgages, investment grade corporate bonds are now the winners. And the floating rate risky stuff or short duration risky stuff that had been the winner up until, I would say, February for 2 years almost, that was the place to be. Those are the places that are lagging now because the floaters are not benefiting from duration. And you're seeing credit spreads widen as equities are in the land of pain, no longer in the land of gain. So through current expectations, this is as of April 2nd. I'm sure this could be a little bit lower. We were expecting barely any cuts as we exited the holidays into December 31st. And now with all the growth concerns, I think we may be up to potentially 3 to 4 cuts now, 100 basis points by the end of the year. But maybe that has to be backloaded. Maybe we need to see more growth, actual hard data corroborate the growth slowdown because the Fed doesn't want to cut too early, especially if we see near-term inflation pressures from tariffs. So again, the Fed is not in a great place right now, and they're not coming to the rescue for markets as we saw today. What's been happening very recently is inflation expectations have been on the rise. This doesn't have 1 or 2 year inflation expectations. If they were on here, they would be even higher. That's really what people are worried about is near-term higher inflation. Longer term, not that you can predict with accuracy 10 to 30 years out, but longer term, the market's still pretty contained from an inflation standpoint. Spreads, this shows you year to date and month over month now. Everything wider except for BBB CMBS, which is, lower rates is good for CMBS because borrowers can refi. It also lagged everything for a few years, so it's kind of still playing catch up, and it had a big run earlier this year. So now marginally everything a little bit wider on the year. This makes sense. Also, it doesn't necessarily mean bonds have bad returns. As we saw, bond returns are positive. If the rate rally is greater than the spread widening, your prices are still up. So fixed rate bonds, rates are down pretty significantly off their highs. The 10-year, if you can believe it, was all the way up towards 470. It's down 70 basis points in basically 90 days here, a little bit less than that. So that is offsetting some of the spread widening. Now, if rates run out of steam on the way down and spreads keep widening, then you'll see some lower prices. But right now, a lot of bond prices are just kind of unch. Rates are lower, spreads are wider, and the all-in yield is about the same as it was before all this movement started happening in the marketplace. Finally, seeing some spread widening on high yield. We had been looking how expensive investment grade and high yield had looked. That's when everything was priced to perfection in January. Stocks could never go down. Corporate credit was like a rock. Spreads could never widen. And here we are just a few days or weeks later, and you're seeing movement. So these dots are now shaking and baking here. They're moving up. You're seeing stuff look much cheaper. High yield got to first percentile. I'm not saying go buy it, but it's things are starting to look more interesting now. Spreads are starting to widen. we're staying patient. We had been moving up the credit curve, de-risking, and basically getting ready for something like this to happen to create volatility, to create opportunities. So we're going to stay patient, but this is now the time to start thinking about, I think, if you're looking at credit, credit's starting to get a little bit more interesting here. It's a little early. Because there's probably a little bit more vol ahead of us. But get ready to find what you want to buy and pick and choose your credits and your sectors that look interesting here. So that's it for today. Hope everyone's portfolios are holding up out there, and we'll catch up next month. We'll see if we've recovered then or if we're still in the land of pain.